Warren Buffett tells you to hold forever. Ray Dalio preaches diversification. Mark Cuban says, follow your passion. You listen. You copy. You lose everything. Here's the paradox nobody mentions. The advice that made billionaires rich is precisely the advice that will keep you poor. Not because it's wrong, because you're playing a different game entirely. When Buffett buys Coca-Cola stock and holds for 30 years, he's playing chess. When you do it with your $50,000 portfolio, you're playing Russian roulette. Same moves, different physics. And physics doesn't care about your dreams. Think of capital like gravity. Not metaphorical gravity, actual Newtonian gravity. A planet with massive mass creates its own gravitational field. It bends space around it, attracts resources, holds atmosphere, sustains life. Your $100,000? That's a pebble floating in space. No gravitational pull, no atmosphere, no margin for error. One asteroid strike, and you're dust. Buffett operates like Jupiter. You operate like a grain of sand. The laws of motion are identical, but the outcomes completely opposite. A Jupiter-sized entity can absorb impacts that would vaporize you. It can wait out ice ages. It can make mistakes and still exist tomorrow. You cannot. This is the gravity trap, and every financial guru selling you their playbook is either ignorant of it or lying. The scale illusion hits first. Buffett says, buy wonderful companies at fair prices, and everyone nods. Sounds simple, mathematical even. But here's what he doesn't tell you. Wonderful companies have minimum buy-ins. Not legal minimums, mathematical ones. To properly diversify across 10 wonderful companies at meaningful positions requires roughly $500,000 minimum. That's just to enter the game he's playing. With $50,000, you can buy 5 shares of each. Know what happens when one company cuts dividends? Your entire monthly income vanishes. When Buffett's position in Apple drops 20%, he loses billions on paper. His lifestyle? Unchanged. Same house, same breakfast, same net worth, effectively. When your $10,000 Apple position drops 20%, you lose $2,000. Your lifestyle? Mortgage payment missed, car payment late, stress hormones flooding your amygdala. This isn't about risk tolerance. It's about risk arithmetic. The same percentage loss triggers completely different survival mechanisms in your brain versus his. Your sympathetic nervous system activates. Cortisol spikes. Decision-making shifts from prefrontal cortex to limbic system. You become biochemically incapable of thinking like Buffett, even though you're following his exact strategy. A 2019 study from the National Bureau of Economic Research tracked 100,000 retail investors copying institutional moves. The institutions averaged 11.7% annual returns. The copycats? 3.2%. Same stocks, same time periods. What changed? Scale physics. Institutions bought after months of due diligence, with position sizes representing 0.5% of total portfolio. Retail investors bought based on 13F filings 60 days later, with position sizes representing 15% of their portfolios. When positions moved against them, institutions had 40 other positions cushioning the blow and could wait 7 years for thesis to play out. Retail investors had nothing and needed that money for their kids' college in 3 years. Identical strategy, opposite outcomes. Gravity. Your practical exit from the scale illusion. Acknowledge you're building mass, not deploying it. Your first $100,000 isn't investment capital. It's gravitational accumulation. You need different physics. High conviction concentrated bets? No. You need broad index exposure with maximum savings rate. Not because indexes are better, because you cannot afford the research infrastructure to pick individual winners, and you cannot afford the diversification to survive picking individual losers. Buffett can hire 50 analysts and buy 50 positions. You cannot. The math doesn't care about fairness. Play the game you're in, not the game you wish you were in. The liquidity paradox strikes next. Buffett's famous for saying, "Our favorite holding period is forever." Beautiful, poetic, catastrophic advice for you. Here's why. Liquidity is inversely proportional to capital size. Massive capital demands illiquidity. Small capital requires liquidity. This is pure physics, not philosophy. When Berkshire Hathaway buys Burlington Northern Railroad for $34 billion, Buffett cannot sell. Not won't, cannot. Who's buying a $34 billion railroad? Nobody. The position is permanently illiquid by design, but here's the magic. He doesn't need to sell. Ever. His gravitational mass generates billions in annual free cash flow from dozens of other sources. The railroad could shut down tomorrow and Buffett still eats breakfast, still pays his bills, still funds his grandkids' trust funds. You buy $10,000 worth of a small cap stock because Buffett said, "Buy wonderful businesses." The stock's average daily volume is $200,000. Your position represents 5% of daily liquidity. Not a problem, you think. I'm holding forever, too. Then your daughter needs emergency surgery. $15,000. Tomorrow. You need to sell. You place a market order. The bid-ask spread is 3%. You lose $300 instantly just accessing your own money. Then the sale itself tanks the stock 4% because you're dumping meaningful volume. You lose another $400. Your $10,000 investment nets you $9,300 when you desperately need $10,000. Meanwhile, if that money had been in an S&P 500 ETF, you'd have sold instantly at the midpoint price with a $2 commission. Same hold forever philosophy, different liquidity physics. Your timeline isn't forever. Your timeline is until the next medical emergency, car breakdown, job loss, or opportunity. Illiquidity is a luxury purchased with excess capital. You don't have excess capital. You have survival capital. Charlie Munger loved to say, "The big money is not in the buying and selling, but in the waiting." Absolutely true. At his scale. At your scale, the big losses are in the waiting, while life happens. Your brain wasn't designed to distinguish between these scenarios because for 99.9% of human history, nobody had this problem. Your ancestors didn't have liquid versus illiquid assets. They had food or no food, shelter or no shelter. Your neural circuitry interprets asset I cannot access during emergency the same as no asset. The cortisol response is identical. But you read Buffett's quote and override your instincts. You wait. You hold. Life happens anyway. You sell at the worst possible moment because biology beat philosophy. The practical exit. Build liquidity first, conviction second. Your first $250,000 needs to be boring. Index funds, treasury bonds, money market accounts, things you can sell in 60 seconds at fair value. Not because these are optimal returns, because these are optimal survival. Only after you've built a liquidity cushion equal to 3 years of expenses can you afford to think like Buffett. Only then does hold forever become mathematically viable. Until that point, hold forever is a grenade with the pin pulled. You're just hoping nothing makes you drop it. The asymmetric recovery trap destroys next. This one's pure mathematics, and it's vicious. A billionaire who loses 50% of their wealth still has $500 million. They're still a billionaire in lifestyle terms. Private jets, mansions, political influence, healthcare, education, security. Nothing changes day to day. More importantly, they only need a 100% return to get back to baseline. Steep, but achievable over a decade. Now you have $100,000. Market crashes 50%. You're at $50,000. But here's where the math gets cruel. You don't need a 100% return to recover. You need the same absolute dollar amount the billionaire needs, $50,000. But that represents a 100% return for you, too. Wait, that seems fair, right? Wrong. Because you can't wait. Your $50,000 doesn't cover your lifestyle anymore. You need to withdraw $20,000 for living expenses during the recovery period. Now you're at $30,000. You need a 233% return to get back to baseline. The billionaire needs 100%. Same crash, same percentage loss. Completely different recovery mathematics. But it gets worse. During the recovery period, the billionaire's remaining capital generates enough passive income to cover lifestyle. Your remaining capital generates nothing. You're withdrawing principal. Each withdrawal makes the required return steeper. This is the asymmetric recovery death spiral. A 50% crash followed by a decade-long recovery destroys the billionaire temporarily. It destroys you permanently. Not because you're weaker, because the mathematics of recovery favor size. Always. This is why Buffett can be cavalier about bear markets. Be greedy when others are fearful. Easy to say when your capital mass generates enough income to live on even after a 70% crash. Impossible to execute when you're selling stocks to pay rent. Daniel Kahneman's research on prospect theory shows humans feel losses twice as intensely as equivalent gains. A $10,000 loss hurts psychologically twice as much as a $10,000 gain feels good. But this ratio changes with scale. Lose $10,000 when you have $50,000 total? That's not 2 times psychological pain. That's 10 times. That's survival threat activation. That's ancient brain circuitry screaming, "You're going to die." Lose $100 million when you have $5 billion? That barely registers. Your brain literally cannot generate enough emotional response to care. Same percentage, different neurobiology. This is why billionaires seem rational during crashes. They're not more rational. They're operating on different neurochemistry. Their amygdala isn't firing. Yours is. Your exit? Accept that you cannot afford symmetrical recovery mathematics. You need asymmetric protection. This means maintaining a higher cash position than optimal portfolio theory suggests. 20 to 30% cash isn't drag on returns. It's insurance against asymmetric recovery trap. It means buying deep in-the-money protective puts on core positions, even though it reduces optimal returns. It means accepting that you're playing defense until your capital mass reaches escape velocity. How much is that? About $2 million liquid. That's the threshold where passive income covers basic lifestyle and recovery mathematics start working in your favor. Until then, ride out the crash is advice from a different gravitational field. The reputation leverage gap opens next, and it's invisible until it bankrupts you. When Elon Musk tweets about taking Tesla private at $420, the stock moves. When he needs capital, banks line up. When he makes mistakes, investors give him another chance. Why? Reputation mass. He's built gravitational pull through previous success. His reputation itself is capital that attracts resources. You don't have this. Nobody does at the beginning. But here's what's sinister. Billionaires give advice assuming you do. Take big risks sounds great from someone with reputation insurance. Every billionaire has failed multiple times. Jobs got fired from Apple. Musk nearly went bankrupt in 2008. Trump filed for corporate bankruptcy 6 times. They all recovered. Not because they're resilient, because their reputation mass bent opportunities back toward them. You fail once with your $100,000? Nobody's calling. No second chances. No investors waiting. No board begging you to return. You're statistically indistinguishable from the million other people who lost money in business. Your failure doesn't become a redemption story. It becomes a credit score, a gap in your resume, a "what happened there" in job interviews. Same risk, different recovery infrastructure. This is the reputation leverage gap, and it means every piece of advice about betting on yourself or taking moonshots assumes infrastructure you don't possess. Cuban says, follow your passion. Easy when you're worth $5 billion and your passion fails, you're still worth $4.8 billion. You follow your passion with your $100,000 life savings? That's your kid's college fund, your retirement, your emergency medical fund.
Your failure doesn't just hurt you. It cascades through your family for generations. Not because passion is wrong, because the cushion beneath passion is made of capital mass, and you don't have it yet. Buffett himself didn't follow his passion early on. He sold golf balls he found in creeks. He delivered newspapers. He bought pinball machines and rented them to barber shops. Boring, practical, cash generative. Only after he'd built capital mass did he start making big philosophical bets. Maybe 3 if you're trying to make a down payment on a house. Completely different mathematics. A strategy optimized for infinite time horizons is catastrophic for finite ones. Compound interest is magic over 50 years. It's barely noticeable over 5. Buffett's wealth came primarily after age 50, after he'd already built massive capital base and could afford to wait decades for compound effects. You're trying to use the same strategy with a fraction of the time. It's like trying to grow an oak tree when you need lumber next month. Oak tree strategy is optimal for oak tree timelines. You have pine tree timeline. Need different species entirely. The mathematical proof is brutal. Starting with $100,000, achieving 15% annual returns, you reach $1 million in 16 years. Respectable. But Buffett's advice is optimized for the journey from $1 million to $1 billion, not $100,000 to $1 million. The strategies that work for growing 9-figure sums over decades don't work for growing 6-figure sums over years. You need faster, more aggressive, higher-risk strategies early. Then transition to Buffett strategies after you've built mass. But nobody tells you this, because the billionaires don't remember the early years. They're psychologically invisible. Survivorship bias erased them from memory. Your exit? Match strategy to timeline explicitly. If you need money in under 5 years, you're not investing. You're saving. High-yield savings accounts, treasury bonds, CDs. Boring. Safe. Appropriate for timeline. If you have 10-year horizon, you can take moderate equity risk. If you genuinely have 30-plus years, then and only then does the Buffett approach mathematically work.
But be honest. Brutally honest. Most people lie to themselves about timeline because they want to believe they can use billionaire strategies. Your wedding is in 3 years? That's not investment capital. Your kid's college starts in 8 years? That's not buy and hold forever capital. Timeline determines strategy, not aspiration. Here's what nobody tells you. Buffett's actual early strategy was nothing like his current philosophy. Young Buffett was a cigar butt investor, buying terrible companies at pennies on the dollar, flipping them fast, taking profits, moving on. Aggressive, opportunistic, high turnover.
Only after he'd built enormous capital base did he transition to buy wonderful companies and hold forever. The advice he gives now is the advice that works now, at his scale, with his mass, not the advice he actually used to build the mass. This is the ultimate asymmetry. The strategies billionaires preach aren't the strategies they practiced. They're preaching from the summit about how to enjoy the view. You need advice about base camp. The math is simple, cruel but simple. With $1 billion, you can lose $999 million and still be a millionaire. You can afford to be wrong 99 times if you're right once. You can wait out decade-long bear markets. You can ignore volatility. You can hold concentrated positions. You can be philosophical about money, because money stopped being survival and became scorecard. With $100,000, you can lose $99,000 and you're broke. You cannot afford to be wrong even 5 times. You cannot wait out decade-long recoveries while paying rent. You cannot ignore volatility when it's the difference between eating and not eating. You cannot hold concentrated positions because one bankruptcy means starting over. Money is survival, not scorecard. Different game, different rules, different physics. The gravitational constant in your favor, time and consistency. You cannot out-capital billionaires. You cannot out-information them. You cannot out-risk them. But you can out-time your current self. Every dollar you save today creates gravitational pull. Small at first, nearly imperceptible, but compounding, growing, accumulating mass. Your job isn't to play Buffett's game. It's to build enough mass that Buffett's game becomes mathematically viable. That number is roughly $2 to $3 million liquid net worth. Below that threshold, you're playing small capital physics. Above it, you transition to large capital physics. The strategies flip. The advice inverts. What was suicide becomes sensible. What was sensible becomes suboptimal. Getting there requires rejecting billionaire advice entirely in the early stages. High savings rate, not high returns. Boring index funds, not exciting stock picks. Multiple income streams, not concentrated bets. Building skills, reputation, and network, not just investment accounts. Avoiding catastrophic loss, not chasing optimal gains. This is anti-inspirational. It doesn't make viral content. It won't get you featured on podcasts. But it's the actual physics of capital accumulation at small scale. Buffett himself did this. He just doesn't remember it clearly enough to teach it. Your advantage? You can move fast. You can change strategy overnight. You can take risks billionaires cannot because you're too small to attract predators. You can invest locally where you have information advantage. You can work harder because you're young. You can learn faster because you need to. These advantages disappear as you gain mass. Large capital moves slow. Small capital moves fast. Use the advantages you have, not the advantages you wish you had. The door is open. The path is clear, not the path they sold you, the actual path. Build mass first. Small, boring, consistent accumulation. Protect downside like your life depends on it.
because it does. Ignore advice from people playing different games with different physics. Save more than feels comfortable. Invest in yourself first, then boring indexes. Then, maybe, after you've built sufficient gravitational mass, start thinking like Buffett. Start holding forever. Start making philosophical bets. Start building for centuries. But not before. Physics doesn't care about your timeline. It simply exists. Work with it, not against it. The gravity is on your side once you understand which field you're actually in. That understanding alone puts you ahead of everyone copying billionaires and wondering why they're going bankrupt. You're not them. You never will be. And that's your first real advantage.